Hello and welcome to the Of Interest podcast. I'm Gareth Vaughan from interest.co.nz. Some 14 months after it began, the Commerce Commission has issued the final 389-page report from its market study into competition in the personal banking services market. Containing 14 recommendations, Finance Minister Nicola Willis and Commerce and Consumer Affairs Minister Andrew Bailey say the government will act on all of them. Joining me to discuss this is Commerce Commission Chairman John Small. Hi John, and welcome back to the Of Interest podcast.
Yeah, good afternoon Gareth, it's lovely to be with you.
Look, you joined us for a previous episode back in March after the draft report in the market study was issued, which probably feels like a long time ago to you right now. At that time, you said the most important of the 16 recommendations in the draft report was the following one, which was the Reserve Bank should review its prudential capital settings to ensure they are competitively neutral and smaller players are better able to compete. This isn't specifically included in the final report, this recommendation. So I was wondering why that is.
Look, we still feel that there's aspects of the regulatory regime that could be improved to promote competition. We've just, I suppose, got a bit more refined about how we're suggesting that happens. And we've keyed in particularly to a number of programs of work that the Reserve Bank already has underway. So we're making a fairly broad overall suggestion about how the bank thinks about competition, which is essentially that we would like them to put a bit more focus on barriers to entry and expansion so that it's more easily able for small players to get into the market, particularly the kind of players that we expect to be able to disrupt this industry, who don't look like the traditional banks. They, may not even have a bricks and mortar premises. They're digital natives. They've got different tech stacks. And they may just be targeting a few of the multitude of banking services. So it's those kinds of players that we're concerned with, and also some of the smaller banks and non-bank deposit takers. And what we're suggesting to the Reserve Bank is that when they think about barriers to entry, that they think about that a bit more. So to take an example, currently there's an entry fee to become a bank, which is $30 million. That's quite a lot of money. Some other countries have kind of tiered licenses. So you can be a bank light or some other, there's a type of bank without putting down $30 million, and then grow and add to your capital base as you grow, which of course all banks have to do. So that's one example. Another one is that applies more to the traditional banks, is to think about the way that risk weights are calculated for reasonably standardized loans, and make that more granular. Again, this is a way of easing the growth track for smaller banks without compromising anything, and it's consistent with the way international banking is going. So that's a couple of examples. We've got a few more, but yeah, so I guess we've still got the same concern generally about regulation, but we've come at it in a more refined way.
Yeah, and just on that point about implementing more granular standardized risk weightings on home loans, can you elaborate a little bit on what you mean by granular?
Yeah, sure. You could think of it as being a loan that's differentiated by, for example, its loan to value ratio or the debt to income ratio of the borrower, those sorts of things. And so each of those is relevant to how risky a loan is. And it doesn't really make a lot of difference whether that loan's issued by Bank A or Bank B. It's inherent in the loan. And so the way the Basel bankers are going is to suggest that these standardized weights, which are different from the way that the big banks do it, they don't use standardized weights at all. But for standardized weights, which apply to all of the smaller banks, including Kiwibank, make those more granular so that there's less averaging involved. It's a more accurate representation of risk, and it gives them the ability to price loans differently depending on just how risky they are.
Okay. So in terms of the recommendations, obviously 16 in that draft report, 14 in this final report. We've obviously discussed that one around the RBNZ capital settings. To what extent have other recommendations changed from the draft to final report, and why?
I think the two big kind of headline ones are the same, more or less. That is, turn Kiwibank into more of a disruptor and get open banking revved up. We've been quite a lot more explicit about the open banking one and how we see that working, but the Kiwibank one is still sort of sitting there. As I say, on the regulatory, the set of regulatory recommendations, they're more refined, and so we've got potentially. I haven't actually gone back and compared with the draft, but I think we may have more recommendations in there, but they're more tailored as a result of consultation and research we've done since March. And then there's a whole set there that many of which I think were there at the draft on consumer information, although we've certainly added in a piece about community and cooperative housing, which we've been alerted to, and we think that that's an area where prudential regulation could properly be refined so as to promote growth of that sector, which is super important in New Zealand. And kind of, cooperative housing is just not a thing in New Zealand, and this is part of the reason it's treated as a commercial loan rather than a housing loan. What else is there that's changed? The work around mortgage advisors is also more nuanced, I should say, probably the way to put it. We found out quite a bit about the mortgage advisor sector after the draft report, and we had some of them around at our consultation conference, which was a wonderful event. Everyone had to listen to each other, and took some soundings in Australia about how their mortgage advisor sector works. So we've got some much more nuanced recommendations there.
Okay. And yeah, as you noted, the Kiwibank and open banking recommendations, which were along with that bank capital one, were the sort of big three in the draft report, are still there, and more detail around open banking. I'm keen to have a look at those two. So in terms of Kiwibank to start with, I mean, how much capital and scale does Kiwibank need to be able to compete with the big four banks on something like an even playing field?
Look, I haven't got the exact figures. We haven't done corporate financial modelling for them, but we do know that they will be capital constrained in the near future. Like all other banks, they are they're faced with rebuilding their tech stack, their core banking system, and we've talked to them in detail about that. So there's quite a bit of investment that needs to go in there. There's also, I think, a mandate question about, so it's one thing providing the resources, it's another thing getting the strategy in place to give effect to putting those resources to good use. So all of those things are pretty important, but I wouldn't put a figure on exactly how much they need.
Okay, but I guess scaling up Kiwibank to be on something resembling a level playing field to the big four banks would be a process that would take years, isn't it?
Yeah, I think it would take a few years. And I should say, by the way, that the main competitive benefit that we see from doing that is about the process of growth rather than what happens once they're big. We want them to be taking chunks of market share out of the big four on their way up, and for that to provoke a competitive reaction from the larger banks. And that's the process, that's the way that a strong competitive process will work, and consumers will get benefit from that. So let's say, I don't know exactly how many years it would take or what the end state would be, but directionally it seems absolutely right. But I will emphasise that we think the main benefit will happen as it's growing rather than when it's there. Because once it gets there, it looks like the other four, and unless it's given a kind of a permanent disruptor mandate, it'll probably act much like the other four. And of course, if you give it a permanent disruptor mandate, then it's a bit harder to raise capital.
So the market study focuses on home loans and deposit accounts. Now, obviously, ANZ, ASB, BNZ, and Westpac combined have market shares of these markets of, I think last time I looked, somewhere between, in the mid 80% range up towards 90%. How much market share do you think they need to lose in the markets for these products to make them materially more competitive? The markets, that is, rather than the banks.
I haven't got a number for you, but I will say that what will really matter will be them perceiving a real threat of losing share, because that is what will stimulate them to fight back. At the moment, their growth targets for the Big Four are they're not particularly aggressive, I'll put it that way, and their market shares are pretty stable over time as a result. And that's kind of one of the big symptoms that we've observed. So that's what we want to disrupt. And I think that as soon as that chill wind and prospect of losing whole points of market share, until they perceive that, they will continue playing the same strategies that they've got, which are perfectly understandable and normal for any organisation in their position.
So on to open banking. So interesting thing about this is that in the report, it refers to what's happened or is happening in open banking, obviously in New Zealand and in the United Kingdom and Australia, where the journey is ahead of New Zealand. I'm just wondering, though, that, obviously the UK and Australia, they're ahead of New Zealand, but they're still fledgling, I think, in open banking there. I think probably that would be fair to say. So I'm just wondering, where in the world is open banking making a real difference to competition?
Well, you could think of open banking as notionally divided between payments and other types of banking. Payments obviously are pretty important there. There's plenty of places around the world where open payments have been extremely successful. And what we've done, I guess, is in terms of the whole open banking piece, we've looked pretty closely at Australia and the UK and thought about what lessons can come from that. And one of the things that's really, I just mentioned, is interesting to us is that in Australia, yes, they've been going for a few years, but they're only now getting around to payment initiation and adding that to the functionality of their open banking system. Our approach is almost to lead with payments, because that is an area that it's where there is a lot of innovation. You can build a business, fintech can build a business and grow it quite quickly, and it's integral to open banking. So we see, so that's one of the lessons that we've seen around the world. There's other lessons from Australia about who controls the API standards, for example. Some of the lessons from the UK are about the method that you use to get it started. We heard some real interesting stuff from the Westpac CEO at the banking conference about she had actually been involved in a committee that was established by the CMA, which is our sister organisation in the UK, under their auspices, but with sort of representatives of the banks and independent chair, and that really kind of drove it. So we're adopting that. We're just copying what we can, ruthlessly copying what we can that seems to work in other places. So I absolutely grant you that that in terms of overall open banking, as distinct from payments, it hasn't been a roaring success in either of those places. I think we can learn from both of them and do it a lot better.
Okay, but are there any other countries that you've looked at in the course of the market study?
Well, on the payments side of things, we certainly have, and there's different model. Again, there's different models around the world for how that's done. Some of them are really kind of explosively successful. So India and Brazil are famous for just runaway successes in low-cost instant payments. Both of those countries did it by central government fiat, if you like, by the Reserve Bank saying, we're going to do this, we're going to set up this network, everyone's going to use it. So that's their ethos, and it certainly has worked to create a fast instant payments network. That doesn't seem, I don't think that's feasible in New Zealand. And I would also suggest that a more diverse payments landscape is needed, and open banking landscape is needed and valuable in New Zealand. So people trying different things who've all got an edge. So, one of the things that we're doing in that space, for example, is although we're pushing down interchange fees on Visa and MasterCard, we're not pushing them to zero, because we think it's important that there be a small margin in there for fintechs who want to get into the payment space, and payments being the gateway to open banking. So, yeah, I don't pretend we've done an exhaustive international study of all this stuff, but we've taken the best from what we can find.
So, I guess down the line, once open banking is fully up and running in New Zealand, I think you want it to be fully operational by June 2026. How should we measure its success once it has been up and running properly for a while?
Public acclaim. I think if ordinary people on the street see it as being useful and working for them, then that's a great indicator. It's not, obviously you'd need a survey or something to do that. I would like to see it taking market share off the banks, definitely. I'd like to see more variety of services out there, and definitely like to see the government's agencies using it, because I think that's an important driver of success. And I think there'll be other aspects to it as well, Gareth, like the AML, the anti-money laundering rules in New Zealand really need a shake-up. They are incredibly constricting, and fixing that is an imperative that's driven by the desire for open banking. It's almost like so that would be a legacy benefit of getting there. Is in order to do that, you'd have to fix this system, which is, it's contributing to financial exclusion. It's playing havoc with Maori trusts who want to borrow money. It's making it really hard for fintechs to get a basic bank account. So some of those things, they would be the sort of indicators I'd be looking at.
Okay. So in the press conference this morning that Commerce and Consumer Affairs Minister Andrew Bailey and Finance Minister Nicola Willis held in regards to your report, Bailey noted that 54% of customers have never changed banks ever. I think he got that figure from your report. So I'm just wondering on that, one of your recommendations is for industry to invest in making improvements to its switching service, which of course is run through the bank-owned company Payments New Zealand. I'm just wondering, what exactly should they be doing here? Can they be trusted to do it? And also, surely promotion of this service to raise public awareness is also a key part of it.
Absolutely right. It is. Promotion, in fact, is one of the big things that we're asking for. We were a bit surprised, to be honest, when we visited the headquarters of the big banks and asked them about this service. And ask them in particular, if I was to come in off the street as a customer of someone else's bank and was interested in converting to you, would you recommend that I use this service? And generally speaking, no, they wouldn't. And they don't ask their staff to recommend that. So that tells me that it's not being promoted. So we think there's ways it could be improved. The actual functionality could be improved. It needs to be more visible and known. And also they need to report on its usage, its success rates, what people think about it, and just that sort of basic transparency, hygiene system around that, I think would be very helpful indeed.
So obviously you will have been encouraged to hear Nicola Willis and Andrew Bailey say this morning that the government is going to act on all 14 of your recommendations. I guess, though, put my cynic's hat on. Obviously, the actions of politicians are ultimately going to be more important than the words. But let's you certainly must be encouraged at this point to be hearing that.
Oh, very much so. I've been quite impressed with. We've briefed both those ministers, obviously, about the report, but they've really seem to have digested it, understood the main themes, and I'm delighted that they are willing to get behind it. And I think we do have a great opportunity here to make a real difference. And one thing that's particularly of interest to me is that we, the Commission, want to stick with this work program and use the designation that we've asked for as a credible threat of regulation to hold banks accountable for kind of an industry-led process, but guided by official constraints, such that if they take their foot off the gas, we can step in and do it for them. And if they're going off track or people are defecting, they can be brought back into the fold. And I think that kind of combined process of industry and government working together, that's what I'm really looking forward to. I'm really excited about the fact that the Commission's got the potential to get in there and stick with this. So unlike other, market studies where we've sort of handed over our building products one is a good example, handed over to the government, said, hey, here's what's wrong with the regulatory regime. Could you please go and sort it out? We've got the opportunity here to do some of that ourselves and kind of put our money where our mouth is, I suppose.
And obviously, there's a parliamentary select committee in banking inquiry that's coming up as well. They've called for submissions, put out their terms of reference, and that's also going to look at obviously business and rural banking. So it's broader than this market study. But I mean, I guess if we tie all these pieces together, but particularly focusing on your Commerce Commission market study, I mean, what's your message to bank customers as you come to the end of the report phase, but obviously, as you say, you're hoping to remain involved?
My message is you really should shop around. I don't like to just sort of put everything back onto the consumers, but consumers can get better deals than I was aware of before I started this market study, for example, on mortgages. You can usually drive a better bargain than you see on the headline rate. So shop around and be a savvy consumer, and I suppose also stand by and keep your eyes open for the innovation that we think is going to come. Some of this, by the way, is going to require change by consumers. There are a bunch of people out there, quite a large number of people in New Zealand that are using somewhat dangerous banking technology that involves handing over their login details to a third-party provider. We think that that's something that has to be phased out. It's just dangerous. It's putting people at risk. So we think that what's coming up is going to be faster, safer, cheaper, it won't happen tomorrow, but it will be here within 18 months to 2 years, I think.
Well, look, John, thanks so much for that. That's John Small, who's the chairman of the Commerce Commission, talking about the final report in the Commission's market study into competition in the personal banking market. And I'm Gareth Vaughan at interest.co.nz with another episode of our Of Interest podcast.